Welcome to the deep dive. We cut through the noise, find the key info, and deliver it straight to you. Today we're jumping into something that hits, well, pretty much everyone's wallet, tax deductions. Specifically, that big choice, standard deduction versus itemizing. Our goal here is pretty simple. Make sense of it all so you understand how to potentially lower your taxable income. It really can make a difference to your bottom line. But before we get into the nitty-gritty, just a quick heads up. This deep dive, especially the examples and how we explain things, it's all based on material from Farhat Lectures. That's farhatlectures.com. Seriously, great stuff there, comprehensive accounting resources. So whether you're studying accounting, prepping for the CPA exam, or you're already a pro, definitely check them out for more practice, videos, all that good stuff. And a big thank you to Professor Farhat for letting us use this material. Okay, so tax time. That moment arrives, you're looking at the forms, and there's this fork in the road, standard or itemized. Let's start with what sounds, well, easier, the standard deduction. What exactly is that?
Yeah, the standard deduction really is the simpler route. And think of it like a flat discount the government gives you on your income. It's a fixed amount, right? And how much it is depends on your filing status. Are you single, married filing jointly, head of household?
Yeah.
And importantly, this number changes each year. You got to look up the current year's amount. Just for context, for 2023, if you were single, it was $13,850.
$13,850, okay.
For married filing jointly or a qualifying surviving spouse, that jumped up to $27,700.
Right.
And for head of household filers, it was $20,800. So pretty straightforward numbers.
So yeah, a fixed amount, no need to track every little thing, sounds nice and simple. But what if you think, hey, wait, my actual expenses might be higher than that number? That's where itemizing comes in, right? Yeah. How does the itemized deduction work?
Exactly. The standard deduction is easy, but itemizing, that's the other option. Instead of that one flat number, you actually list out specific expenses that the IRS says, okay, you can deduct these.
Okay. So you're keeping track.
You are. You add up all these individual eligible deductions. And here's the key thing. You always choose whichever total is greater.
Greater, right.
Is your total of itemized deductions bigger than the standard deduction amount? Or is the standard deduction bigger? You pick the bigger one.
Because the goal is always
to reduce your taxable income as much as possible legally. So bigger deduction equals lower taxable income.
Makes perfect sense. Maximize the reduction. But, is it always worth the effort to track everything? It sounds like it could be a lot of work, especially if you end up just taking the standard anyway.
That's a really good point. It definitely takes time. You have to gather receipts, categorize things, add it all up. And if, after all that, your itemized total isn't actually higher than the standard deduction, well, you've done the work for no extra tax savings that year.
Right. You've spent the time, but didn't get a bigger deduction.
Exactly. So knowing what actually qualifies is super important. It helps you decide if it's even worth trying to itemize for your situation.
Okay, so let's get into that. What kinds of things can we itemize? Where do these typically show up?
Right. So these deductions usually get listed on Schedule A of your tax return. There are basically 5 main categories, plus a sort of miscellaneous one we can touch on. First up, medical and dental expenses.
Okay, doctor bills, prescriptions.
Yeah, things like that. But there's a big catch here. You can only deduct the amount that exceeds 7.5% of your adjusted gross income, your AGI.
Whoa, okay, 7.5% threshold. What's AGI again, roughly?
AGI, adjusted gross income, is basically your gross income minus certain specific deductions. Think of it as your income before taking either the standard or itemized deductions.
Got it.
So if your AGI was, say, $100,000, that 7.5% threshold is $7,500. You'd need more than $7,500 in unreimbursed medical expenses before you could even start deducting anything in this category.
So it's really for folks with pretty high medical costs relative to their income.
Exactly. It targets significant expenses.
Okay, what's next after medical?
Second category is state and local taxes, often called SALT.
SALT. Right. I've heard about this one.
This includes things like your state and local income taxes or sales taxes if you choose that option, and importantly, property taxes on your home.
Okay, so state income tax, property tax.
But here's a really crucial detail, a big one. The total amount you can deduct for all these SALT taxes combined is capped.
Capped at what?
It's capped at $10,000 per household per year.
$10,000. That's it. Even if you paid way more in state income and property taxes combined.
That's right. $10,000 is the maximum SALT deduction, regardless of how much you actually paid. This was a major change from a few years back and definitely impacts people in higher tax states.
Wow, okay. That's a huge point to remember. $10 cap on SALT. What's category number 3?
Third is interest paid. The main one here for most people is home mortgage interest.
Right, paying interest on your house loan.
Exactly. There's also interest paid on investment loans, though there are specific rules there too. But for many homeowners, the mortgage interest deduction can be pretty substantial. There are limits, especially on very large loans, but it's a common one.
Okay, mortgage interest. Makes sense. Number 4.
Fourth is charitable contributions. So donations you make to qualified charities.
Like giving money to the Red Cross or a local food bank.
Precisely. It can be cash, but also things like donating stock or even sometimes out-of-pocket expenses you have while volunteering for a charity. You need documentation, of course.
Right, got to have proof. Okay, that's 4. What's the 5th main one?
Fifth is casualty and theft losses. And this one got much more restrictive recently.
How so?
Now, these losses are generally deductible only if they happen in a federally declared disaster area.
Oh, wow. So not just any unfortunate event. It has to be like a hurricane zone, wildfire area.
Correct. Declared disaster area. And even then, there are 2 more hurdles. First, each separate loss event has to exceed $100. That's sort of a small floor.
Okay, minus $100 first.
Right. But the bigger hurdle is that your total net casualty losses for the year must be more than 10% of your AGI.
Another AGI threshold, 10% this time.
Yep, 10% of your adjusted gross income. So again, this is really aimed at significant catastrophic losses in very specific circumstances.
Man, okay. Medical at 7.5%, casualty at 10%, plus that SALT cap. Lots of rules and percentages.
It definitely is. And there's that miscellaneous category too, but the main action is usually in those 5 we just covered.
This really shows why just having expenses doesn't automatically mean itemizing is better. The rules matter.
A lot. Absolutely.
I think seeing it all play out with an example would really help solidify this. Can we do that?
Definitely. Let's use that John and Judy example from Farhat lectures. It's a good one.
Perfect. Lay it on us.
Okay, so John and Judy, they're married, filing their taxes jointly. Let's look at their income first. John earns $40,000 in wages. Judy earns $60,000. So their combined income, which we'll use as their AGI for simplicity here, is $100,000.
Okay, AGI earns $100,000.
Got it. Now, their potential itemized deductions for the year. Let's list them out. They had unreimbursed medical expenses. John had $8,000. Judy had $1,000. So that's $9,000 total medical.
$9,000 medical.
State income taxes. John paid $2,000. Judy paid $5,000. Total state income tax, $7,000.
All right, 7K state income tax.
State property taxes. They each effectively paid $3,000 on their assets, so that's $6,000 total in property tax.
6K property tax.
Home mortgage interest. Combined, they paid $7,500.
$7,500 mortgage interest.
And unfortunately, they had a loss due to damage in a federally declared disaster area. After applying that $100 floor per event, their calculated loss for tax purposes is $14,000.
$14,000 casualty loss. Okay, that's quite a list of expenses.
It is. Now remember, the standard deduction amount for married filing jointly in our example year?
You said earlier it was $27,700 for married filing jointly.
Exactly, $27,700. So that's option 1 for John and Judy.
Okay, so if they just take the standard deduction, path 1 is simple. $100,000 AGI minus $27,700 standard deduction. That gives them a taxable income of $72,300.
Correct. Nice and easy calculation. $72,300 taxable income.
Now for path 2, itemizing. We need to apply all those rules we just talked about to their expenses. Let's break it down. Medical first.
Right. Medical expenses were $9,000 total, but remember the rule. Deductible only above 7.5% of AGI.
Their AGI is $100. 7.5% of that is $7,500.
Perfect. So they can deduct the amount over $7,500. That's $9,000 minus $7,500, which equals $1,500 deductible for medical.
Okay, $1,500 for medical, not the full $9,000. What about the taxes, SALT?
Okay, SALT. They paid $7,000 in state income tax plus $6,000 in property tax. That adds up to $13,000.
$13,000 total paid. But wait, that cap?
Exactly. The SALT deduction is capped at $10,000 per household, so even though they paid $13,000, they can only deduct $10,000.
Okay, so $10,000 for SALT. Next.
Home mortgage interest, they paid $7,500, and in this case, it's fully deductible for them.
Nice. Okay, $7,500 for mortgage interest. And finally, that casualty loss.
The casualty loss was $14,000 after the $100 floor. The rule here is it's deductible only to the extent it exceeds 10% of AGI.
AGI is $100, so 10% is $10,000.
Right, so their deductible amount is $14,000 minus that $10,000 threshold, leaving $4,000 deductible for the casualty loss.
Okay, $4,000 deductible casualty loss. Phew. So now we add up all those deductible amounts for their itemized total, right?
Let's do it. We have $1,500 from medical, plus $10,000 from SALT,
Got it.
plus $7,500 from mortgage interest,
Okay,
plus $4,000 from the casualty loss.
So 1,500 plus 10,000 plus 7,500 plus 4,000, that adds up to $23,000.
$23,000 is their total calculated itemized deduction.
Okay. The moment of truth for John and Judy. They have two options. The standard deduction of $27,700 or their itemized total of $23,000. Which one do they pick?
They pick the higher number to get the biggest tax benefit. In this case, $27,700 is clearly higher than $23,000.
So even with all those expenses, medical, taxes, mortgage, even a disaster loss, they're still better off taking the standard deduction.
That's right. In this specific example, the standard deduction gives them a larger reduction in their taxable income. And this happens quite often, especially since the standard deductions were increased significantly a few years ago, alongside that SALT cap being introduced.
That example is incredibly helpful. It really drives home how those thresholds and caps work, and that itemizing isn't always the winner, even if you have decent expenses. But it makes me wonder, what if they were close? What if their itemized total was, say, $27,000, just under the standard? Is there anything people can do strategically?
Ah, yes. This is where tax planning comes into play, beyond just tax preparation. There's a strategy called bunching deductions.
Bunching, like grouping things together.
Exactly. Let's say you know your itemized deductions are usually right around the standard deduction amount each year, maybe slightly below. Bunching means you try to strategically time some of your deductible expenses so that you concentrate them into one specific year.
How would that work? Give me an example.
Okay, charitable contributions are a common one for this. Maybe you normally donate $5,000 a year to your favorite charity. Instead of doing that every year, you might decide to donate $10,000 in December of year one, covering both year one's and year two's intended donation.
Ah, I see. So you pull next year's donation into this year.
Right. Or maybe you have some flexibility on when you pay certain state taxes or make a large medical payment if it's elective. By pulling expenses forward or sometimes delaying them slightly to fall into a specific year, you try to bunch enough deductions into that single year to push your itemized total over the standard deduction threshold.
So in that year, you itemize and get a bigger deduction than the standard. What about the next year when you have fewer deductions because you paid early?
Then, in the next year, your itemized deductions would likely be much lower, well below the standard amount. So in that year, you just take the standard deduction.
Clever. So you alternate. 1 year itemize with bench deductions, the next year take the standard.
Precisely. It's a legal way to maximize your deductions over a 2-year period, rather than potentially losing some of the value of those deductions each year if they consistently fall just below the standard amount. It's a bit more advanced, requires planning, but it's a valid strategy.
That's really interesting. It shows there's more to it than just adding things up at tax time. It involves looking ahead. So wrapping this up, what's the big takeaway for everyone listening? It seems like understanding this standard versus itemized choice is more than just paperwork. It's actually part of managing your money well.
Absolutely. The main point is that while the standard deduction is often simpler and might even be the best choice for many people, like John and Judy in our example, you should still have a basic understanding of what could be itemized. Know the major categories, be aware of those AGI limits and the SALT cap. Because your situation might change. You might have a high medical expense year, or buy a house and start paying mortgage interest, or become more charitable.
Right, knowledge is power here.
It really is. Knowing the rules lets you make an informed choice each year and potentially plan ahead with strategies like bunching, if it makes sense for you. Don't just assume the standard deduction is always the way to go without at least considering the alternative.
Excellent point, and that leads perfectly into a final thought for you to chew on. We've talked about choosing standard versus itemized, and even bunching. But think about this. How could really understanding the details, those AGI percentages for medical and casualty, that $10,000 SALT cap, actually empower you to plan your spending or timing of things throughout the year to optimize your tax situation down the road? It shifts the focus from just reacting at tax time to potentially making strategic financial moves all year long. Something to definitely think about as you navigate your own finances.